Hello, guys. This is episode number 15, part 2. In this episode, we're going to discuss the Wyckoff five-stage cycle. Okay. And the Wyckoff proposed a model known as the Wyckoff five-stage cycle to describe the stages of price movements in the market. Okay. So these stages are accumulation, markup, distribution, markdown, reaccumulation, or redistribution. All right. So total 5 stages: accumulation, markup, distribution, markdown, reaccumulation, or redistribution. So total 5 stages are there in the markets. That's how the price move in the market. The price move in cycles or stages. We call it as Wyckoff five-stage cycle or Wyckoff five-stage movement. Okay. So these are the Wyckoff five-stage cycles. All right. So first call, we're gonna start with the accumulation. This is a stage occurs when the smart money or institutional investors or large operators starts accumulating shares at lower price, often under the radar of general market participants. So in this stage, what happens that the smart money or the institutional investors or the large operators, they start accumulating shares at a very low price or at a lower prices, and these accumulation of shares are not visible to the general market participants or to the retail traders. Okay. They quietly accumulate the shares at the lower prices. Now, markup. Following accumulation, the market enters a markup phase characterized by a sustained buying pressure and upward price movement as the demand overwhelms the supply. What happens here? In the accumulation, supply and demand are equivalent. Okay, they are supply is equals to demand or demand is equals to supply. Okay, the market is in equilibrium during the accumulation stage. Okay, in the accumulation, the smart money, institutional investors, or the large operators, they start to accumulate the shares at a lower price. Okay, and this accumulation process is quiet. Okay, it is hidden from the general market participants or the retail traders. In the markup is followed after the accumulation. Okay, the markup is done after the accumulation. Okay, in the markup, that the market enters the markup phase characterized by a sustained buying pressure. Okay, so the buying pressure is increasing during the markup. Okay, and the market enters the markup phase. The markup is also known as uptrend. Okay, and during the markup, there is an upward price movement as the demand is greater than the supply. Okay. Now we have a distribution. In this stage, the smart money begins to distribute their accumulated shares to the public at higher prices, leading to a price consolidation or sideways movement. Okay. This process is also done quietly and it is hidden from the general public. So what happens that the smart money begins to distribute their accumulated shares to the public at a higher prices. So the public are buying the shares from the smart money at a higher prices, and this leads to the period of consolidation or sideways movement or the ranging market. Okay, this process is also done quietly. Then we have the third stage, which is known as the fourth stage, which is known as the markdown. After distribution, the market enters a markdown phase marked by a selling pressure. So during a markdown process, the selling pressure increases, okay? And the supply exceeds the demand, so the price moves downward, okay? Reaccumulation or redistribution. Depending on the prevailing market conditions, the cycle may repeat with another round of accumulation or distribution, leading to a new phase of price movement. Within the markup and markdown phases, after the markup and markdown phases, okay, the smart money quietly accumulates or distributes the shares, okay, at a lower or higher prices, okay, and this process is quiet, and the price moves in consolidation or range during this phase, during reaccumulation and redistribution. The price is actually in equilibrium, okay, and here the supply is equivalent to demand. By understanding these stages and their associated characteristics, traders can better identify market trends, anticipate reversals, and make more informed decisions. If you understand all of these 5 stages, you gonna make you gonna identify the market trends in a better way. You can anticipate the reversals, and you can make better trading decisions. These additional concepts further enrich the Wyckoff method, providing traders with comprehensive framework for analyzing market behavior and identifying profitable trading opportunities. Okay. Once you understand these 5-stage cycles, okay, you will have a very enhanced understanding of the Wyckoff method. Okay. It will give you a framework to analyze the market behavior and to identify the profitable trading opportunities. All right. So I'm going to show you the 5-stage cycle now. Now, this is a 5-stage cycle. Here you can see that the smart money is quietly accumulating the shares at a lower prices. Okay. This process is quiet and it is hidden from the journal market participants or the retail traders. Here, the supply is equals to demand, so the price moves in a range or consolidation. All right. Then we have the markup phase. Here, the demand is greater than the supply because the buying pressure is more than the selling pressure. So the price move upwards during the markup phase. This is reaccumulation. After the markup, the price reaccumulates. Okay, the smart money reaccumulates the shares. Okay, at a lower prices, and this process is quiet, and it is quietly done. Okay, and this process is hidden from the general investors or general traders or the general market participants. Okay, in this stage of reaccumulation, supply is equals to demand. So the price moves in consolidation, equilibrium, or in a range or sideways market, as you can see from here. Then we have the markup. Here, the buying pressure increases. So the demand is greater than the supply. When the demand is greater than the supply, the price moves up during this markup phase. This is known as markup phase. Then we have the distribution phase. During the distribution phase, the smart money quietly distribute the accumulated shares to the retail traders or the other market participants. This process is hidden, and here the supply is equals to demand, so the price moves in a sideways market or in a ranging market. Okay. Then after the distribution, there is a markdown. Okay, during the markdown prices, the selling pressure is more than the buying pressure, and the supply is more than the demand, so the price moves down. Okay, then after markdown phase, we have a redistribution. Okay, in a redistribution, the smart money quietly redistributes the shares to the general market participants. Okay, and this process is quiet. During this process, the supply is equivalent to demand, so the price moves in a range or sideways market, or even in a consolidation market. You can see over here. Here, the supply is equals to demand. Then the smart money sells and the selling pressure increases. Okay. When the selling pressure increases, this means that the supply is greater than the demand. Okay. When the supply is greater than the demand, the price moves down. Okay. Here again, this is accumulation. The smart money accumulates the price at a lower prices, accumulates the shares at the lower prices. Okay. This process is quiet and it is hidden from the retail investors or the general market participants. Here, the supply is equivalent to demand, so the price moves in a sideways market or a ranging market or in a consolidation market. So we can say that price is in equilibrium. The supply is equivalent to demand. After accumulation, again, the markup process is repeated. Then we have a reaccumulation, then markup, then distribution, then markdown, then redistribution, then markdown, then accumulation. And again, the process is repeated. Okay, after accumulation, there is a markup. Then there is a reaccumulation. After reaccumulation, there is a markup. Then after markup, there is a distribution. After distribution, there is a markdown. After markdown, there is a redistribution. After redistribution, there is again a markdown. And after markdown, there is again a an accumulation. So this process is repeated throughout the market over and over again. This is known as Wyckoff 5-stage cycles. Now we're going to see on the charts how this looks like. Okay. Now let's suppose I have open a chart here. Okay, I will show you. Let's start from here. This is accumulation. Okay, here the price is moving in a range. Okay, the supply is equivalent to demand, and the smart money is quietly accumulating the shares. Okay, and this process is hidden from the retail investors or retail traders or general market participants. In this phase, the market moves in a range. You can see that the market is moving in a range. All right. I can draw a pathway tool to identify it. Okay. You can see that the market is moving in a range. This is accumulation. Now, this one is markup. Okay. This is markup. This phase is known as markup. Here, what happens, the markup is also known as uptrend. Remember that. Okay. So this is markup. Okay. Here, the buying pressure is more than the selling pressure. The demand is greater than the supply. So the price is moving up. Okay. Now here, you can see that again, the price is moving in a range. We can say that okay, we can extend it and we can see that the price is moving in a range. Okay, we call this process as reaccumulation. So smart money or the institutional investors, they are reaccumulating the shares at a lower prices. Okay, this process is quiet. Here, the supply and demand are equal. That's why the price is moving in a range. You can see the price is not moving up or down. The price is moving in a range. Okay, the price has no general direction. Here, the supply is equals to demand. The price is in equilibrium. This is known as reaccumulation stage. And after a reaccumulation stage, what do we have? We have a markup. We call this stage as a markup or uptrend. Okay. As we know that during this stage, you can see that the price is moving up and we can see that the buying pressure is more than the selling pressure. The buying pressure is more than the selling pressure. Okay. So we can say that the demand is greater than the supply. So the price is moving up. Okay. Now here, you can see that the price is moving in a range. Okay. You can see that the price is moving in a range and the price, and here the smart money is distributing the shares to the retail investors or the retail traders or the general market participants. Here, the buying pressure is equals to selling pressure, or the supply or the demand is equals to supply. Okay. And the price is moving in a sideways or ranging market or in consolidation market. We can say that the price is in equilibrium. We call this stage as distribution. Okay. And after distribution, we have markdown. Okay, so let me just okay, we have a markdown here. So markdown is also known as downtrend. Here what happens that the selling pressure is more than the buying pressure. Okay, the supply is greater than the demand, so the price is moving down. Okay, the smart money is selling here. And now here again, we can see that the smart money is redistributing the shares. Okay, the smart money is redistributing the shares. Okay, and here in this phase, okay, the supply is equals to demand, or the selling pressure is equals to buying pressure. The price is in equilibrium, and so the price is moving in a ranging market, or in a consolidation, or in sideways market. Okay, so we call this phase as redistribution. Okay, redistribution. And after redistribution, the price moves down. Okay, after redistribution, the price moves down, and we call this phase as markdown. Or downtrend. Okay, so I hope everything is clear. We call this phase as markdown or downtrend. Okay, here the smart money is selling the price. Okay, and the selling pressure is more than the buying pressure, so it means that supply is greater than the demand, and that's why the price is moving down. Now here again, as we can see, okay, here the smart money is reaccumulating the shares, okay, at a lower pricing. Okay, the price is moving in a sideways market. We can say that the supply is equivalent to demand, okay, and the price is moving in a sideways consolidation ranging market. Okay, the price is basically in equilibrium because the supply is equals to demand. Okay, we call this phase, and the smart money here is quietly accumulating the share at the lower prices. We call this process as accumulation. So you see that the cycle repeats itself again and again over the chart. Okay, and after accumulation, what do we have? We have the markup. We call this as markup or uptrend. So what happens here? Here we can see that the buying pressure is greater than the selling pressure. So the demand is greater than supply, and the price is moving up. The smart money is buying here. Here again, the price moves into consolidation. Okay, we can say that the smart money is reaccumulating the shares. All right, the smart money is reaccumulating the shares, and at the lower prices. Okay, supply demand is equals to supply. Okay, uh, the buying pressure is equals to selling pressure, and the price is moving in equilibrium. Okay, the price is moving in ranging market condition, or sideways market condition, or in a consolidation market. We call this as reaccumulation. So you can see that this process repeats. So after reaccumulation, what will happen? We know that after reaccumulation, the price gonna go up. The price gonna go up. Okay, and you can see that the price is going up from here. So this condition would be markup. So I hope here the buying pressure is more than selling pressure. Okay. The demand is greater than supply. So, and the smart money is buying over here. So the price is going up. You can see that the price is going up here. Okay. The price started to go up from here. And the price will further go up to this side, right? Until here. So this is known as markup. So I hope you are clear. I can show you more on the chart. Okay. Let's suppose here. Here, this is accumulation. This is accumulation. All right. You can see that this was a downtrend. So this was a markdown. After markdown, this is accumulation. After accumulation, this is markup. After markup, this area is reaccumulation. And after reaccumulation, we again have a markup. And after markup, we have distribution. Okay. After distribution, we have markdown. After markdown, we have redistribution. Okay. After redistribution, we have again markdown. Okay. And after markdown, we have what? Accumulation. You can see we have accumulation. And after accumulation, the price moves up and we have markup. So this process repeats again and again over time. Okay. On every chart, this process will repeat. And we call this as Wyckoff 5-stage cycle. All right. Now let's go back to our notes. I have explained everything here. And now we're going to read the last few things here, the evolution. Over time, the Wyckoff method has evolved as traders have incorporated new tools and technologies into their analysis. While the core principles remain the same, the modern traders often use advanced charting softwares, algorithm trading strategies, and quantitative analysis techniques to apply Wyckoff concepts into today's fast-paced markets. So what is the evolution today? In today's time, this method is like 100 years old, okay? But for over 100 years old, but in today's market, the market has evolved and the traders have evolved, okay? So the Wyckoff method has also evolved over time, okay? Now it has become more advanced. So the general principles, the core principles or the general principles, they remain the same, but modern traders often use advanced charting softwares like TradingView and some other advanced charting softwares to track the volume and price activity of the institutional traders, okay? And they also use the algorithm trading strategies and quantitative analysis techniques to apply Wyckoff method in today's fast-paced markets. Additionally, the Wyckoff's original writing and teachings have been further elaborated upon and refined by subsequent generations of traders and educators. So the Wyckoff original writing and teachings have also been further elaborated or further modified to adopt to today's market conditions. Okay. But the core principles and the general principles remain the same. Modern adaptation. In its modern adaptation, the Wyckoff method is still widely used by traders and investors around the world. It provides a framework for understanding the market trends, identifying accumulation and distribution phases, and timing entry and exit points with greater precision. Traders often combine Wyckoff principles with other technical indicators such as moving average, trend lines, momentum oscillators to confirm their analysis and enhance their trading strategies. Additionally, there are numerous books, courses, and online resources available today that teach the Wyckoff method in depth, making it accessible to traders of all levels of experience. Okay. So in a modern time, the Wyckoff method has been adopted according to the modern market. Okay. And traders are employing different technical indicators and they are combining it with the Wyckoff principles. These indicators are such as the moving averages, trend lines, and the volume and momentum indicators to confirm their analysis and enhance their trading strategies. Okay, there are numerous books, courses, and online resources that are available today to retail traders and the journal investors and participants of the market. So the Wyckoff method has been accessible to all levels of experience traders. Okay. Overall, the Wyckoff method remains a valuable tool for traders seeking to gain a deeper understanding of market dynamics and improve their trading performance. Its principle continue to stand the test of time, offering the timeless insights into the art and science of trading the financial markets. So the Wyckoff method has stood the test of time. It has been proven again and again one of the best method of technical analysis. Okay, and it has stood the test of time. Okay, Wyckoff method is one of the best method available to traders to trade the financial markets. All right, so I hope you have enjoyed this video. I've explained everything. Okay, this is episode number 15, part 2, and we are concluding this episode, and we're going to move on to the next episode and delve deeper into Wyckoff method concepts.